Emergency move that shocked Wall Street at exactly 2:17 p.m. Eastern Time. Something happened that almost never happens in modern financial history. No leaks, no warning, no scheduled meeting, no press conference. Just a sudden announcement released through the Federal Reserve's internal wire system. And within seconds, trading desks across Wall Street froze. The Federal Reserve executed an emergency interest rate cut outside its normal policy calendar. And to understand how rare this is, consider this. In more than a century of the Fed's existence, this kind of move has only happened a handful of times, usually when the financial system is facing immediate danger. What made the moment even more surreal was how quietly it happened. No televised address, no reporters asking questions, just a short technical statement quietly dropped into the system, and then chaos followed. Within 90 seconds, trading algorithms detected the announcement, and the market reaction was violent. The Dow Jones Industrial Average instantly collapsed by 847 points. The S&P 500 plunged more than 3% in minutes. Bond markets, usually slow and stable, suddenly started moving like crypto prices. Treasury yields jumped to levels not seen since the aftermath of the 2008 financial crisis. Traders scrambled to understand what was happening. Because here's the part that stunned everyone. The Fed didn't make a small adjustment. They didn't trim rates by the usual quarter point. They cut rates by a full percentage point in one emergency move. That's the kind of action central banks normally reserve for economic emergencies, moments when something is breaking beneath the surface. And the official statement? Just 3 short paragraphs. No explanation, no economic details, no reassurance, just cold, technical language confirming the decision and nothing more. And that silence created one terrifying question across global markets. What does the Federal Reserve know that the public doesn't? Because central banks don't act like this unless they believe something serious is unfolding behind closed doors. Investors immediately started connecting dots. Was a major bank in trouble? Was something collapsing in the credit markets? Was another financial crisis beginning quietly in the background? And here's what makes this even more important. Everything that happened that afternoon didn't begin that day. It actually started 48 hours earlier, when the first crack appeared in a place most Americans have never even heard of. A quiet signal, ignored by markets, but noticed by regulators. And once that first domino fell, events started moving faster behind the scenes than anyone outside the system realized. Stay with me, because when we trace what happened over the next 2 days, it reveals a financial pressure building silently beneath the economy, one that could shape markets for years. And by the end of this breakdown, you'll understand why this emergency decision might be one of the most important financial moments of the decade. The first crack in the system to understand why the Federal Reserve suddenly panicked. We need to rewind exactly 48 hours before the emergency rate cut. Monday afternoon, 4:47 p.m. Eastern Time. Markets had just closed, and almost nobody outside banking circles noticed what happened next. A mid-sized regional bank in the Midwest failed to meet its overnight liquidity requirement with the Federal Reserve. In simple terms, the bank didn't have enough immediate cash available to cover short-term obligations due that night. Normally, this isn't catastrophic. Banks constantly borrow from each other overnight through what's called the federal funds market. It's routine, quiet, invisible to the public. But this time something unusual happened. Other banks refused to lend. Not at normal interest rates, not at higher rates, not even at emergency premiums. No one wanted exposure, which sent a dangerous message. Banks were suddenly worried about each other's balance sheets. When private banks refuse to lend, the final option is the Federal Reserve's emergency lending system, known as the discount window. And that's exactly what got activated Monday evening. Quietly, no headlines, no panic. But internally, regulators understood the seriousness. Because by 11 p.m. Monday night, it wasn't just one bank anymore. 3 additional regional banks accessed emergency Fed funding. 4 banks in trouble, all within hours. And the public still had no idea. Tuesday morning arrived, and financial news channels talked about inflation cooling and hopes of a soft economic landing. Markets even opened in positive territory. The Dow Jones started the day up 127 points. Traders were optimistic. Nothing looked wrong. But behind the scenes, alarms were ringing inside Washington. According to sources familiar with internal discussions, Federal Reserve Chair Jerome Powell began making urgent phone calls to the CEOs of America's largest banks: JP Morgan, Bank of America, Citigroup, Wells Fargo. These were not courtesy calls. These were emergency consultations. And Powell was asking one specific question: how exposed are you to commercial real estate loans? Office buildings, shopping malls, hotels, business properties, a sector that has been quietly deteriorating since the pandemic changed how people work and shop. Remote work reduced demand for office space. Online shopping crushed retail locations. Vacancy rates climbed. Property values began falling. And banks have been quietly hoping the situation would stabilize before loans started going bad. But by Tuesday afternoon, regulators realized something alarming. Losses in commercial real estate were much worse than publicly acknowledged. And suddenly, concerns shifted from isolated bank trouble to systemic risk, a term regulators use only when they fear problems could spread across the entire financial system. Treasury Secretary Janet Yellen joined an emergency secure video call with Powell and top banking regulators. Topics discussed: potential bank failures, liquidity stress spreading, risk of depositor panic, and the possibility of credit markets freezing by late Tuesday evening. A decision was made. An emergency meeting of the Federal Open Market Committee, the group that sets U.S. interest rates, would be called for Wednesday morning. Emergency Fed meetings are extremely rare. The last ones happened during March 2020, when COVID shut down the economy, September 2008, during the global financial crisis when the Fed calls officials in on short notice. It means waiting weeks for the next scheduled meeting isn't an option. The situation is urgent. And by Wednesday morning, inside a secured conference room in Washington, 12 Federal Reserve officials gathered to decide whether the banking system needed immediate rescue. What followed was a tense debate with enormous consequences, because every option carried serious risks, and whichever decision they made would shock markets either way. Inside the emergency Fed meeting by 8 a.m. Wednesday morning, top Federal Reserve officials were either physically present at the Fed's headquarters in Washington, D.C., or connected through secure video lines from regional offices across the country. Phones were locked away. Press access was non-existent. And the agenda contained only one item: should the Federal Reserve intervene immediately to prevent a banking crisis? The room was tense because everyone understood the stakes. If they acted too slowly, financial stress could spiral into bank failures. If they acted too aggressively, markets might panic and assume the crisis was already out of control. Officials reviewed overnight data showing banks were increasingly turning to emergency funding sources. Liquidity pressures were spreading, not shrinking. The core issue was simple. Banks were sitting on massive commercial real estate loans that were rapidly losing value. Office buildings in major cities were half empty. Companies downsized office space as remote and hybrid work became permanent. Shopping centers struggled as more consumers moved online. Loans that once looked safe suddenly carried major risk. And the biggest exposure wasn't at Wall Street giants. It was at regional banks, thousands of smaller institutions that lend heavily to local businesses and property owners. If those loans started defaulting in large numbers, regional banks could quickly face capital shortages. And once depositors lose confidence, bank runs begin. The committee reviewed 3 possible options. Option 1. Do nothing. Officials could wait for the next scheduled policy meeting 6 weeks away. Hope markets stabilize. Avoid alarming investors. Let banks solve their own liquidity issues. But the danger was obvious. If even 1 or 2 banks failed publicly, depositors across the country might start pulling money from similar institutions. And modern bank runs happen digitally. People don't need to stand in lines anymore. Money moves instantly through mobile apps. Billions can leave banks in hours. Option 2. Small rate cut. A cautious move. Cut interest rates by 0.25%. Signal awareness without triggering panic. But critics argued this might not be enough. If banks needed relief immediately, a small cut would barely lower borrowing costs. Markets could interpret the move as hesitation. And hesitation during financial stress can worsen fear. Option 3. Massive emergency cut rates by a full percentage point. Immediately inject confidence and liquidity into the system. Lower borrowing costs overnight. Show markets the Fed was willing to act decisively. But this option carried its own danger. Investors might think, If the Fed is cutting this aggressively, how bad must things really be? Markets could panic anyway. The debate stretched on for nearly 6 hours. Some officials warned such a large cut risked reigniting inflation later. Others argued inflation concerns meant nothing if the banking system itself came under threat. Finally, the committee voted. The decision was not unanimous. 3 members opposed the aggressive cut, warning it could create long-term problems. But the majority believed immediate action was necessary. The vote passed. Interest rates would drop 1 full percentage point, effective immediately. And with that decision, staff prepared the official announcement. No press conference, no questions, just a short statement sent through the Federal Reserve wire system. At 2:17 p.m., it went live. Trading algorithms picked it up instantly. And instead of relief, markets reacted with fear. Stocks plunged. Investors dumped bank shares. Bond markets swung wildly because traders immediately asked the same question. If the Fed needed to act this fast, what problem are they trying to contain? By the end of the trading session, markets suffered their worst day in months. But here's the most concerning part. The Fed never explained exactly what triggered the move. And when regulators stay quiet, markets assume the worst. Now the entire financial world is watching one thing: whether this emergency action is enough, or whether something bigger is already in motion. Is the crisis just beginning? By the time markets closed that day, the damage was clear. The Dow Jones finished down more than 1,200 points. The S&P 500 lost over 3%, and the Nasdaq dropped more than 4%, its worst session in months. Financial news channels switched into crisis coverage mode. Analysts debated whether this was just market overreaction or the beginning of something more serious. Because here's what made the situation dangerous. The Federal Reserve gave almost no explanation for its emergency action. And when central banks stay vague, it's usually intentional. Officials don't want to name specific banks or troubled sectors because doing so could trigger panic withdrawals and make problems worse. But even without direct confirmation, data gives clues. U.S. banks currently hold nearly $3 trillion in commercial real estate loans. Office buildings across major cities are struggling with record vacancy rates. Property values have fallen sharply in many markets. And here's the ticking clock. Roughly $1.5 trillion in commercial real estate loans must be refinanced over the next 2 years. The problem? Many property owners borrowed when interest rates were near zero. Now refinancing happens at much higher rates. Some buildings simply aren't worth enough anymore to support their loans. When owners can't refinance, they default. When defaults rise, banks absorb losses. When banks absorb losses, they tighten lending. And when lending slows, businesses and consumers struggle to access credit, pushing the broader economy toward recession. Large banks like J.P. Morgan or Bank of America can absorb losses better due to diversified portfolios and huge capital reserves. But regional banks don't have that cushion. Some smaller institutions have 40 to 50% of their loan books tied directly to commercial real estate. If those loans sour, capital problems appear quickly. And once confidence disappears, contagion spreads fast. That's exactly what regulators fear, not isolated failures, but a chain reaction, which is why the Fed moved so aggressively. Not because the system has already broken, but because officials believe it could break if stress spreads. So what happens next? Over the coming weeks, 3 signals will reveal whether this emergency move worked. First, watch bank earnings reports. If banks start setting aside significantly more money to cover future loan losses, it confirms deep stress in the system. Second, watch Federal Reserve data on emergency bank borrowing. If banks continue relying heavily on Fed support, liquidity problems haven't gone away. Third, listen carefully to public appearances by top officials. If Treasury or Fed leaders suddenly begin reassuring markets, it usually means concern remains high behind closed doors. Right now, the system isn't collapsing, but it is under pressure. And the most important question isn't what the Federal Reserve did today. It's whether that action is enough to stop what might be coming next. If conditions stabilize, this moment will be remembered as a successful intervention that prevented a crisis. But if stress continues to spread, historians may look back at this emergency rate cut as the moment the next financial downturn truly began. And the answer will reveal itself not in speeches or headlines, but in what happens quietly inside the banking system over the next few months.